Hey everybody, it is Sunday, April 24th, and this is episode 59 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at the price action last week. Okay, so this was an interesting one because there were some forecasts that I made last week that either almost came true or were half true but not quite. But either way, I'm going to be overcritical of myself, and so I marked those down as red X's, meaning that the forecasts were not correct. But let's take them one at a time. So the first one is we did not stay within the settlement range. So if you look at the chart, you'll see that the expected settlement range, which is those two, the lower and upper settlement limit in the green, was between 42.69 and 44.66. Well, technically we settled at 42.67.25, so we were like 1.75 points away from settling within the range. So I was off by less than 2 points, but the point is I was off. So we did close outside of the settlement range, even if by just a fraction. The next one is the breach of the breach points. Well, we definitely had that. In fact, we had a double breach. So we breached to the top side, we went up, and we breached that 44.62 upper breach point, and then we came back down and we breached the 43.46 lower breach point. So we definitely had a breach of the breach points. And then the last one, which I'm marking it as a red X, is whether or not the market moved as predicted. Well, if you remember from last week's episode, I said that I thought we were going to hit that 43.46 lower breach point. And we did, but I'm still marking myself as being wrong because I said that I thought we were going to hit that 43.46 breach point before we would come back up to a red midline. And so I gave it more of a chance that we would hit the lower breach point and not the upper breach point. And what actually happened was the opposite. We went up, breached 44.62, breached the red midline, and then came down. So even though we did breach 43.46, the market did not move as predicted because it went the opposite way before coming back the way that I thought it was going to. All right, and now let's take a look at the moving averages for going into this next week. Short term is bearish, medium term is bullish, and long term is bearish. And how is that possible? Well, I mean, it's very simple because the short term is 5-day versus 20-day, and so in this case, the 5-day is below the 20-day, but the medium term is 20-day versus 50-day, so the 20-day is higher than the 50-day, and then the long term is 50-day moving average versus 200-day. 50 is below the 200. So what this signals to me is that long term, there's still a very much a bearish mentality or sentiment in this market. Medium term, that really just indicates to me that we're confused. I mean, and I don't mean that we don't know what's going on, but I mean that there's a lot of forces at play, a lot of push and shove, push and pull going on in the market right now, and that's why you have that big split there between the short term and long term versus the medium term. And then the short term, obviously weighed down by the last 2 days of the previous week. Given this spread here, I would say that we're still bearish overall. I'm not going to put too much weight on that medium term moving average just because you're bound to get that the buy the dip phenomenon. So people come in, they buy, it goes back up, but still short term. Going into next week, I'm looking at it very bearish, especially layered on top of an already bearish long-term moving average. All right, and let's put this into the price chart for next week. So here are the ranges that I'm forecasting for next week. The breach points are at 41.68 to the downside and 44.25 on the upside. So those are the two breach points with odds of 81.4% chance that we will breach one of those 2 points. In this scenario, given, like I said before, the bearish sentiment going into the week, I'm going to say that the path of least resistance is for us to continue down and breach that 41.68 lower breach point. Now let's take a look at the settlement range. So we're forecasting that the market will settle between 41.38 and 43.29 with a 72.1% odds that it will do so. Obviously, that is a lot less than the 81% chance that we will breach a breach point. And if we do in fact breach that lower breach point, then we would have to, really turn it around or hit the brakes on the free fall in order for us to still close above 41.38. So what's interesting is, even though I believe that 41.68 is the more appealing of the 2 breach points, I'm going to say that it's going to be easier for us to stay within the expected settlement range if we just flat out didn't have a breach of the breach points at all, or if we just barely went down and touched that 41.68. If we just blow right past that 41.68, then you would need a pretty big swing back up to the top side to get us back above 41.38. So something to keep in mind as we go into the week. All right, now looking at didn't see that one coming. Well, I think I mentioned this already, that I didn't see it coming, that we would go up first and breach above that midline before we would go down. But hey, double breach, I'll take it. I mean, that volatility for anybody trading options, that's going to really fatten up those premiums for you guys. And the volatility it makes for a fun and wild ride if you're on the right side of it, or it makes for a very painful and nerve-wracking experience if you're on the wrong side. So hopefully you're on the right side, but I didn't see it coming. And as we look into next week, there's so much going on. I mean, honestly, I think that looking at that path of least resistance and looking at the price charts, I'm seeing a ugly setup to where it can really kind of continue free falling down. But this market is just known for doing something like that and then just turning around and breaking out. I mean, it'll go straight down and then it'll come straight up in a V formation. I mean, we've seen it time and time again before, so expect a bumpy ride in this week and probably the next week ahead at least. All right, and let's wrap up now with the quote of the week. This one is by Mr. Benjamin Graham, who, interestingly enough, he's not only a pioneer in the fundamental valuation industry or space, but he's also a mentor to Warren Buffett. And, he must have done something right there, right? I mean, because if you've heard of Warren Buffett, well, anyways, looking at Mr. Benjamin Graham's quote here, it says, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. All right, this is awesome. I love quotes like this because they make you think. So what does Mr. Benjamin Graham mean by in the short run, the market is a voting machine? Well, that's because money flowing into and out of the market, going into and out of positions in the short run, basically represent the opinions and sentiments of people during that trading session, right? So you have money constantly flowing in and out, whether it's people or algorithms, which were programmed by people. Let's not forget that. That short-term swing and that short-term volatility, that's everybody casting their ballots. That's day in, day out, every minute, every second, people just constantly money in, money out of the market. So that's the voting machine that's always running. But in the long run, it's a weighing machine. And what it means is it's going to, the scales are really weighing out much larger fundamental elements that are at play here, factors, because you're looking at the economy, you're looking at growth, you're looking at geopolitical circumstances. There's a lot going on which is not fairly captured within a day's trading session. So short term, voting machine, up and down. Long term, that's where we start looking at how it's really weighing what's going on in the economy and what's going on in the world. This is a great quote also because if you remember the moving averages earlier today, short-term moving average, that's your voting machine. That's bearish. Long-term moving average, that's the weighing machine, and that is also bearish. So in this case, both the votes and the weighing, the scales are saying that things are ugly. But I don't have to tell you that because you can look at the charts and you can just tell yourself. Hopefully it's not hitting your portfolio too hard. But going into this week, remember, a lot of volatility still expected, and it's definitely looking like it's setting up for some more ugliness to the downside. So be prepared, and I will see you guys here next week so we can dissect it and see what's going on based on our forecast and what we expect for the following week. All right, guys, take care.